All right, we'll go ahead and get started. Welcome to Bridging the Financial Gaps, the second webinar in our webinar series, A Business Plan for Your Building. I'm Amanda, the Executive Assistant here at Studio GWA, and please bear with me as I take care of some housekeeping things. If you have any questions during the presentation, please ask in the chat and I will pass them along to our presenters. We will have a Q&A time at the end where we invite you to unmute and ask your questions. We'd love for you to go ahead and make use of our chat now by telling us where you are joining us from and what is your connection to the development world. And of course, this webinar is being recorded. It is my pleasure to introduce to you our speakers today. First, we have Ashley Sarver. On our last webinar, I told everyone that it was her caffeine, her love of caffeine, that makes her great at what she does. But I recently learned that she stopped drinking caffeine. So now I'm thinking that it is just her passion and her authenticity that makes her supernatural in her ability to analyze market conditions and perform pro forma work. Next, we have Aaron Holverson, a principal architect who can masterfully blend a building's history with its new life. Where others see the past, Aaron envisions the future ways a building can contribute to a community. Aaron understands that the built environment is the background for our lives and how it shapes us. His passion makes him an asset to any development team. Finally, we welcome our special guests, Brad Roos and John Lanpher. Brad is the owner of Midtown Faust, one of our historic tax credit projects here in Rockford. Brad's firsthand experience with development makes him an invaluable resource to the development finance conversation. And John is a business attorney that works with traditional and creative financing structures. He has knowledge of what makes a financial structure work and is able to navigate risk as well. Both Brad and John bring an expert lens to bridging the financial gaps of development. And with that, I will pass it over to Ashley.
Thank you, Amanda, and thanks everyone for coming. We actually switched our order, so I'm going to give it back to Aaron.
Well, hello all. This segment of the webinar series is called Bridging the Financial Gaps. I'm just going to run through a quick overview of who we are here. Let me get my screen to actually advance. We're Studio GWA, a small architecture, interior design, and planning. We do development assistance as well. We're based in Rockford, mainly, with some staff kind of around the country. So yeah, community planning, development services, architecture, and interior design is what we do on the daily. For those of you who may have joined us last time, or maybe you're watching this and having just finished episode 1, we talked about the starts, the commercial redevelopment basics. And if you may remember, we got to a number that anybody doing small development may have encountered, which is a negative number, the return on investment. So we left it on the cliffhanger. What do we do next? That is often the question that people come to. So what now? So we're going to talk about the different ways to bridge that financial gap that often exists. So I'll do a quick intro. One of the things that we'll talk about here is the value of HTCs. Historic tax credits is one of the tools that we utilize to bridge those gaps. They're multifaceted, state and federal. They, as it's noted on the slide, close the gap, reduce risk, pair well with a lot of other incentives, and they're pretty versatile in who claims them. There's a couple of kind of necessary things here. The building needs to qualify. You'll see on the screen here, the building either needs to be an individually listed building on the National Register, a contributing building within a district, a National Register district, not just a local historic district, but a National Register district, and those that can be made up or that can be achieved in a number of ways. Most of the communities that we work in, I don't know if I can think of one community, I guess, that we've worked in that hasn't necessarily had a district in some form. They probably exist, but most of the smaller communities and larger ones that are around that you're familiar with will have a district in some form or some individually listed buildings. So those are the components of, or what kind of the prerequisite to being able to utilize this program. So some of the questions you may ask, you're looking at a building, does the building qualify? If it's not already listed or is not already listed as a contributing building, that doesn't mean it can't be. At some point, somebody has to make that decision for it to become. So this is how one might get there. Some of the criteria for listing can be history related. It doesn't have to be just on architecture. Architecture is one of the components, but it can be history related. So that can be related to important events in the history of a community or important persons. If you are from Illinois, there's, everybody claims to have something related to Lincoln. So there's always a Lincoln connection, it seems, in some of the history ones. But so it can be either history or architecture, but there is an entire process to get to that point. So that's one of the criteria to get there. But once you're there, then you're eligible for the program. So I'm going to now kick it over to Ashley, and she can kind of talk about what the numbers are, the numbers side of things.
Yeah, and on the eligibility, if you have a project with your building qualifies for the redevelopment itself, you then just have to follow the standards for rehabilitation, which is a lot of what we come into play, on the design side, as well as working with the State Historic Preservation Office and the National Park Service. And then when you have those standards met, you are able to then go after these historic tax credits. So there is a 20% federal historic tax credit. And then in most states, there's a 20 to 25 state credit. And so, not all states have it, and not all states have it exactly the same. As you can see in this map, this is a great resource of just checking what is going on in my state or what might be going on in a state that I want to do development work in. You can click on the state and it tells you which ones have a state credit. So you'll see all of the ones in yellow have some type of state program. It's worth noting though, like the programs currently in Michigan, currently in Pennsylvania, as an example, those are pretty small and pretty competitive. So while the state ones are maybe a little bit more fluctuating in how they work, the federal one is something you can count on. So that's an additional 20% credit for your project, and that is an income tax credit. So that offsets your income tax, your liability, and can be used for the development project as equity. So it really helps fill the gap, like Erin mentioned, if you have a gap in that capital stack where either you can't get additional financing from the bank to fill that gap, or you can't get funds from the city. It really is a program that you can nicely step into to be able to help fund that. If you go to the next slide, I think there's always the question of what costs qualify, and it really is, I think, pretty impressive with this program how many costs qualify. So it's your hard costs that you might expect for the renovation, but it's also some of your demolition costs. Granted, you're not you're not demolishing these historic features that are important to the building, but I say you need to redo the roof, you need to replace the windows, things like that. Your hard costs are qualifying expenses. And a good portion of your soft costs, so your development costs that just go along with the project, your fees, your professional fees that you might have for architectural and engineering, legal fees, permits, your historic tax credit consulting fees, your developer fee you can take the credit on that and put that as a credit back into the project. So most of your soft costs qualify, though not all. And things that don't qualify would be your acquisition costs or anything that's outside of the envelope of the building. So if you have a parking lot, that wouldn't qualify. If you build a rooftop deck, the costs related to that would not qualify. And your furniture and equipment don't qualify. So the analogy we give a lot of times is that if you took the building and held it upside down and shook it, whatever fell out would not qualify, but whatever sticks would. So kind of an oversimplification, but gives you a good sense. And I always like the thought of a building being a salt shaker. So if we move on to the next, you can kind of look through the financial stack. So this is just kind of a project example of, I would say a smaller scale project to some degree. I know $2.15 million is still a good amount of money, but in terms of a redevelopment project, it wouldn't be unheard of to see, you know, a number like this for, say, a Main Street style building. So this just breaks out some typical expenses, our land and acquisition costs, our fees, permit studies, our direct construction, indirect construction costs, financing fees, and our developer fee. So you can kind of follow the path right and see which costs are eligible out of that. Note that the acquisition cost does not carry over, but most of those other expenses do. And so from that, we take that and use that to calculate our state and federal historic tax credits. This particular project was one we looked at in Wisconsin, so you'll see that it's a federal 20% and a state 20%. Projects in Illinois have a 25% state historic tax credit. So if you follow that through, you can see at the very bottom then what are sources that we're going to use for this project. When you have those historic tax credits in there, you're able to keep your loan to a minimum as much as possible. So with that, you see we have an $873,000 loan and an annual mortgage payment of $85,000. On the next slide, when we take those out, all of a sudden that goes back into our loan and what we owe the bank, and our mortgage goes up almost by double in this scenario. So you can see how those tax credits play a big role in being able to finance and fund the redevelopment. And that's kind of just a quick primer. If we go to the next slide, it will be my pleasure to hand it over to Brad Roos, who's made good use of these historic tax credits, and he'll talk us through a little bit more on his project, how it worked, and how those the financials came together for him. Brad?
Okay. Thank you very much, Ashley. And thank you, all of you folks who are attending the webinar today. I was asked to touch on 3 different things. What were the financial hurdles for our project? What advice would we offer? And then what do I wish I knew before I did the project, perhaps? The project itself, we call it the Midtown Faust project. In the slide, you can see above the sign, this is by the way, this is the before picture. And above the sign that says Jagger Saw and Cutter, you'll see in limestone there, Faust, which is the name of the builder who is well known in the Rockford, Illinois area. We believe his name was actually Victor Builder, was the guy that built the building, but that his brother, Victor Faust, was the brother of Levin Faust, and Levin Faust built Rockford's fanciest hotel, which remained that way for a long time. The financial hurdles that we experienced were really not that great. And I say that because I have some experience working with low-income housing tax credits. I'm pleased to see Jim Keeling as one of the attendees today. Jim was the attorney for one of those projects, which is interesting and great. And he was a great help. Thank you, Jim. So every project is unique, as I'm sure many of you know. And so there are always some problems to solve, which is what makes it interesting. In our case, we kind of backed into this project wanting to do something in our own neighborhood. We live right in this neighborhood, 700 feet away from this building in a condo. And so figuring the initial cost was something that we worked very briefly on, but we were committed to the project, so we felt like we could go forward without an in-depth cost estimate. It would have been good to have that, but I have to tell you, if I had it, I might have not done the project. And also costs change over time too, so that's always a challenge. My wife, Sue, and I took on the project and used we made a private loan to the project out of commitment to the neighborhood. So that was not actually a hurdle other than should we do this? And, as the project went on and as the costs went up. Our commitment to that, at least in terms of a construction loan, kept increasing, but we never really got terribly uncomfortable with it. I think the one of the other hurdles, and probably in many ways the most significant hurdle, was how to engage the historic tax credits. And that's because we elected to, in every possible way, to engage our neighbors. So we wanted to engage our neighbors in the construction process, hire our neighbors wherever we could. We wanted to engage our neighbors to benefit from the physical building itself, which is a 3,500 square foot single story commercial building with a full basement. That's wonderful, actually. And we also wanted to benefit our neighbors in the community on the investment side, rather than go with a capital house, a bank, or some of the more traditional forms of investment. That part turned out to be a challenge. And particularly when our attorney at the time and our CPA told us, no, you can't do that because your friends and community members probably won't have passive income, which is what you'd need to have to offset the passive credits of the historic tax credit system. Well, it turns out that that's not accurate. If we found, and this took some digging on both of our parts, fortunately, my retired social worker wife enjoyed doing taxes for others and actually worked for H&R Block 3 summers in a row because she enjoyed the people. And we together found that if you look at IRS tax form 8582-CR, and that, by the way, in case you needed to be told, the slide up now is the finished product of the project. And what we found was that in IRS form 8582-CR, there is absolutely a way for individuals to take the historic tax credits, whether they have passive income or not. So that was a huge, huge green light for us, and we were very thrilled to see that. When we showed that to our attorney and to our CPA, they said, oh, I guess you can do that. So that actually made it possible for us to engage people. We engaged actually 20 households in the project, 27 actual individuals. And those folks contributed a total of $225,000 in equity to the project. So that was terrific. We were grateful for that. It amounted to almost exactly 1/3 of the project cost, which is in line with what the pro forma that Ashley showed earlier today. And when we did this by bringing multiple people in, and this was a challenge, we couldn't bring them all in at once. We brought in about half of them at first, but then the rest came in later. And so we needed to develop, and did so, develop a tiered system where people bought into the project, you could say, by paying different levels for their contribution to the limited liability company that owns the project. So that was just a complexity, but not really that hard. Advice, make sure your attorney and your CPA know about 8582-CR. That's important. Secure your investors early if you can. That's the simplest way to do it, and it keeps you from having a tiered system in terms of the investor buy-in. We used a lot of volunteers. Now, that is advice because along with engaging our neighbors, what we found was this wonderful and tremendous engagement of the community, and they felt invested. And I have to tell you that not only was it a personal joy to work with many of the folks, more than what you see on the screen there, volunteers put in, including Sue and me, put in a total of over 13,000 hours on this project. In addition to that, those people, actually, some of those people brought to us tenant ideas, and those folks were among the folks that we eventually ended up seeing as tenants, and they're terrific tenants, and we're really glad for that. And I think the community feels a sense of obligation, and they've got skin in the game. So it made it really special for us. And I guess my last piece of advice would be sure to use Studio GWA. And I'm not just saying that because I've known Gary Anderson for a long time, and I've had the pleasure of knowing Ashley and Aaron, who both worked closely with us on the project. Just couldn't have really done it without them. To have an integrated firm like that, vertically integrated, that can handle both the credits and the architecture was really great. Yeah, if I'm doing okay on time, and I don't know how to tell that exactly, but I would say that if I wish there anything I wish I'd known beforehand, if I'd known about 8582-CR from the beginning, that would have saved a little angst, but we did figure that out. If I'd known how bad the building was in terms of the physical shape of it, it might have been helpful. But again, if I'd known, I might have said, yeah, I don't really think we want to, do this much. Fortunately, we did not spend a lot for the building. So that's my contribution to this. As you see on the slide in front of you, we made sustainability a huge value for our project. And we reclaimed about 3,000 board feet of lumber from the building and reused it. We also reclaimed the 4-inch square glass tiles, which are a beautiful addition to it. But something that's not on the screen is that we also recycled over 20,000 pounds of metal out of the building. And that metal was scrapped by our neighbors. And one neighbor drove by one day to show me his brand new sedan that he bought with the money that he saved that he got from scrapping the steel that we gave him. So it was a wonderful project in terms of sustainability and, of course, preserving a building like this. Personally, I would say that this model would work beautifully for virtually any Main Street project in small towns anywhere, particularly if they have access to the state credits as well as the federal.
Brad, on the next slide we have here, this one. Sorry, the one with the colorful. The next,
yeah,
yes,
that one.
Yeah. I think what we hear a lot of times from some clients is that the historic tax credits seem complicated. And so if I'm going to get friends and family to invest, how do I easily explain how this works to them? And maybe you can talk a little bit to that, and then also to the spreadsheet that you created here. We have probably about 5 minutes before we pass it to John. So I wanted to get that info from you.
Yeah, thanks. I had thought about touching on that too. So the first thing you want to do is not show them this screen because eyes might glaze over if they saw this. But in essence, you can say this project has worked for other people and it can work for you, regardless of whether you have rental income as part of your household income or not. And then you can say, if you would like to estimate it, if you have further interest, you can use this investment estimator, which I created, which engages the tax tables from, I think, 2022, when we started securing investors. And you really only fill in the information that's in the red rectangle at the top, and then everything else follows through as an estimate. So that actually, it turned out to be extremely useful for almost all of the investors in terms of figuring out, gee, will I be able to use these tax credits in 1 year, or will it take more than one? Something that I think Ashley taught us was that historic tax credits can be used for your, for your income tax for the given year, but they can also carry back to a previous year. And of course, assuming that you paid your taxes the previous year and your income's about the same, that means you just get that money back. And then if you've still not used up all your tax credits, they carry forward for up to 20 years. Wow, I mean, that's a pretty spectacular program there. And it's helped a lot of people, in my experience, to decide to go forward with making an investment in this project.
That's great. Yeah. Thanks, Brett. I think it's the way hearing you phrase it, how you pitched it to people is helpful, especially as, you try to cut through all the complexity. And I agree, a spreadsheet isn't the best way to first introduce it, but I think you're right. Everyone did find this spreadsheet incredibly helpful throughout that process. So
Ashley, one piece, Ashley, I think I would say that did make it simple. As I said, if you invest in this project and you can use all the credits in your first year, you will get a return of investment of approximately 10 to 15%. And if you calculate that on a per annum basis, I mean, it's a lot more than that. The point being is that if you do that, that was enough for most people. Honestly, when individuals are investing, they're not just investing in the project, they're investing in their community. And they want to find a way to make that work. So there's a lot of heart, I suppose you could say, in this. It's not I'd say for almost none of the investors that got involved was this purely a financial calculation.
Yeah. And I think that speaks to just how you all have taken this project and done it with, goals and values in mind from the beginning, and the commitment to the neighborhood. So as you can see in the photo, it's a great addition right on the corner, very visible, and is fully leased up. It was fully leased, and I know you've shared, Brad, that the Pottery Studio has tripled their business since moving in there and are busting at the seams, which is great.
Yep.
So thanks, Brad. I think we'll jump over to John. As Amanda introduced him, he's a business attorney, and we've talked with John over the years about development and development opportunities. And every once in a while, something new comes up. And John and I were talking about this a few months ago, and I thought, well, that would be great information to share as we talk about creative financing. So, John, I'll pass it on over to you.
Well, thank you, Ashley. Yeah, Brad was talking about investors and how they come in and what motivates them to come into a project. What I'm going to talk about is the standard way that probably Brad went about it, and then the second thing we're going to talk about is a little bit different step in adding a different step that attracts investors. The first is more of a standard way of doing things, and that is where the developer identifies the real property and, of course, creates a pro forma budget. And from the pro forma, the developer will determine what level of contributions he'll need from investors in order to get to entice a commercial lender to come in. So to get the investors, the developer goes and creates the private placement memorandum that addresses and gives it to the prospective investors. And in that private placement memorandum, there will be items such as the type of entity that would be chosen to own the property and do the development and own the property, the minimum investment that each investor is going to be asked for, the use of the proceeds, risk factors, terms of the subscription agreement, market conditions, management structure, management personnel, summary of compensation to be paid to the managers, expenses and reimbursements paid to the manager and affiliates. There might be some conflicts of interest depending upon what entities are involved in the development. Reports to members, and then the terms of the operating agreement of the eventual LLC. So the investors will then come in an equity relationship, basically putting money straight into the LLC, and the LLC uses those funds to do its pre-development due diligence, which includes site selection, permitting, organizational and customary offering expenses, and a portion of that proceed may be used to acquire the land. And as further described in the private placement memorandum, the remainder of the private money proceeds combined with lender financing will be used to develop and construct the project, establish cash flow reserve accounts, and be used by the managers for operations, working capital, capital improvements, etc. The above method that we just talked about has risk to the investors because if for some reason the project fails, the investor really doesn't have much recourse against the LLC. So we came up with this other step. This is the second option now, where instead of an investor coming in directly into the LLC as an equity holder, they become, they loan money to the LLC. So instead of equity money that's totally at risk, they loan money to the limited liability company, and it's evidenced by a promissory note. And it's like a debenture because it's an unsecured note, but they loan money into the LLC versus immediately becoming a member. That loaned money is used for the pre-development, due diligence activities like we talked about above. And then at a time certain, the developer advises the private lenders if the pre-development due diligence results in a proven project, one that's viable. And then after viability is determined, at the election of the private lender, the principal balance of the promissory note and optionally any accrued interest is convertible then into equity into the limited liability company. And at that point, the investor becomes an equity holder or a member of the LLC. Now, if a private lender converts the note to equity, they could choose to convert both principal and interest, or just the principal, and they would receive a pro rata distribution based upon the amount they converted into equity. Also, to give flexibility to the private lender may tranche the principal of the note. In other words, a private lender may choose to convert only a portion of the note to equity and leave the rest under a note. This is a flexible arrangement that both the developer and the investors like. My experience is, however, most of the investors who have been private lenders decide to go ahead and convert all of the principal and all of the interest into equity. But those flexibilities are out there. Now, this method is a bit more expensive for the developer because he's paying interest on the note until the investors convert to equity. But as an example, we've got a $50 million project going on right now, and $30,000 in interest payments really is not a significant sum. And it's a good trade-off for the flexibility that both the developer and the investors have. Again, the private lender has a choice whether to proceed as a lender, creditor, or as an equity holder. The private lenders are not mandated to convert the note to equity. Private lenders may remain as such and collect principal and interest just like any other loan scenario. Now, under the first scenario, the investors only, where they just put money in as equity, they have to wait for distributions to start seeing a return. Those that go under the private lender scenario, they start getting interest right away. Well, it's accrued, but they start getting accrued interest right away on their money until they convert. Equity investors are not creditors. All their money is at risk right away. But private lenders are in a more secured position than an investor only, being that they are a creditor to the developer LLC company. unless and until they convert their note into equity. So in sum, you have two choices, maybe there's more, but the two choices are just go in straight as an equity holder or go through the process of becoming a private lender, and then at a time certain, accepting that the project is proven out, then they can go ahead and convert into equity. The developers like it because it attracts more investors that way. The investors like it because they get interest on their money, and they still get a dollar for dollar conversion into equity for the principal of their note and for any interest that they also want to contribute. So that is, that's another way that we've been doing things that has been very helpful to developers, especially on bigger projects. When you have relatively sophisticated investors that understand the process of they're starting out with the note scenario. Of course, along with the private placement memorandum comes a subscription agreement, which basically means that you're identifying yourself as an accredited investor. The only projects I've been involved in is where my client entices accredited investors to come in. Although there are scenarios where people that are not accredited investors can come in, but it's relatively limited. So that is my presentation. If anybody has any questions, I'll kick it back to Ashley, Aaron, Amanda, anybody.
John, I have one for you. On the interest rate that these private lenders find acceptable, how does that compare with what you might get from a bank for the interest rate?
Well, private or the developer I'm working with pays 10%, 10 plus.
Okay, so that's like I guess what we see a lot is, at least a 10% return is helpful if you're going to be fully invested in the project, have a 10% at least ROI.
Well, yeah, the pro forma,
and from the bank,
the pro forma will, once you convert it into equity, then you're subject to the performance of the LLC, and the return on that investment is higher than what you'd get under your interest payments under the promissory note, typically.
Got it. So there's incentive to continue along with the development.
Yes, and most people see, well, this particular developer I work with has a track record of being very successful. So they've seen that these investors jump in pretty much at every opportunity to join with this developer. And in all cases, they have converted all their note principal and interest into equity because they know the history of these projects.
Thanks.
We'll go ahead and open up Q&A time to any of you who might have questions. Feel free to unmute and ask. We just remind you that it's being recorded, so if you share any project-specific details, remember that it's being recorded.
Just real quick, I think I have to allow the mics here, so I'm just going to do that real quick in case anyone was trying to talk. Just give it a second here. There we go. You would still have to unmute, but you are allowed now. Sorry for that. While people are thinking of things, I have a question maybe first to John, but then also for Brad, of how important is your team? John, you mentioned, the client you have now has a good reputation. What if you're someone just starting out? What would you recommend about the team that they form?
Well, Brad is correct that you need to have a CPA, because if you're going to be given a pro forma by the developer, and unless you're pretty savvy in that regard yourself, you're going to want to run that by a CPA. You're going to want to have an attorney to take a look at the private placement memorandum to kind of help you through and understand the risks that are involved either as just a straight investor or even as a private lender that turns into an investor. And you're going to want to also have an attorney look at the operating agreement that would be in draft form that goes out with the private placement memorandum, because there are many terms and conditions in those operating agreements that make a difference as to how easy it is for you to sell your interest, or something happens to you physically and you're not competent, what happens to your ownership interest, what rights the managers have, because these would be manager managed operating companies, and what rights and you do or do not have as a member under a manager managed operation. So that's where your lawyer comes in. And other team members may be, if you want to invest a certain amount of money and you don't have cash to sit around, could be that you might have a lender, your own lender, that could talk to you about what sort of loan you might be able to get in order to be a participant as a member in this developer LLC. So those are three team members. And of course, if there's any need for you to retain an architect to take a look at the plans that have been submitted, I can't leave out the architects.
It wasn't a leading question to start,
Yes,
but thank you for the plug. Fred, anything to add on that?
I would agree with John 100%. Every one of those team members that he mentioned is crucial. I think John is maybe modest in underselling himself here. There aren't maybe a ton of attorneys who have experience with tax credits, particularly with historic tax credits. So making sure that your attorney and your CPA have experience with projects like this, or can have access to information like this, is just, it just simplifies the whole process and gives you quick and reliable answers. One of the things that I actually forgot to mention too, that's important in terms of the team, and your CPA particularly should be able to tell you this, is that our CPA agreed to answer questions that potential investor partners might be interested in asking, as long as he said, I'll answer for free as long as I don't have to fill out a form. Because if I have to fill out a form, then my company requires me to start charging. So people were able to call the investor, and the CPA, and ask questions of that person, and get a reliable, quick, direct answer that was, related specifically to the project. So that, and of course, we always advised. I think sort of a shadow part of anybody's team like this would be the investor partner's own tax preparer, so that person is aware of what their client is about to do, and can say, yeah, this is how it would work for you, or maybe it won't work as well as you think it will, or give advice on that. And a specific point on that I should have mentioned earlier is that while IRS Form 8582-CR does say that individuals can invest in projects like this, even if they don't have passive income, there is, for historic tax credits only, there is a limit to how much your AGI, your adjusted gross income, can be. And that limit is $250,000. Actually, it starts to phase out at $200,000. This is a great irony, and it's upsetting actually to me in a way, because communities that want to see a historic project renovated and they want to invest, and maybe there are a couple of people in town who would really like to see their own community benefited, and they've done well in life and have the cash, maybe not able to do it because their own income exceeds that $200,000 to $250,000 limit. So I think it's important in a webinar like this to mention that and also to say that any potential investor really needs to have their own attorney or their own tax preparer weigh in on how this will affect them.
That's helpful. Thank you both. And I think we talked a lot about tax credits today. It's not always the right fit for every project, depending on, what your goals are, what the project needs to be, what the final design needs to look like. But they have filled a significant gap for many, many projects. And so I think that's a great resource to lead into for potential redevelopment. That's why we thought it was important enough to put a webinar together to talk about it.
Yeah. Ashley, you're not seeing any other questions yet. As a result of conversations with you in your office, a fellow from Gibson City, Illinois, a small town in the central Illinois, called me and asked me some questions about this. And we spent an hour and a half on the phone, and he actually is the city's community development director. And after the conversation, throughout the conversation, he kept saying, why wouldn't everybody do this? Why wouldn't everybody do this? And I think we don't want to get sort of lost in the weeds here. The fact that this is just a spectacular way for especially smaller communities with historic buildings, and they all have them, right? They all have them, to see significant improvements in their community and to engage their community to do it. So I agree with the guy from Gibson City. Why wouldn't everybody do this?
That's great. Thank you.
We agree.
Go ahead.
We had a question from Mark.
Yeah, hi. Thanks everybody for the presentation. Really appreciate it. Good to see some familiar faces. I just had a quick question for Brad on the Faust project, and just because on a personal note, my background is more so in the kind of market research, financial analysis side of these types of projects, or just real estate generally. And for someone that would kind of in the future like to do a project like this one, like the Midtown Faust, or be able to do a historic project, what was your sort of expertise in the construction side of things? Did you have a general contractor that you trusted and that you knew you were getting the right pricing from, or you had kind of an idea of what sort of the challenges were going to be on something like this? Because as you mentioned, there's with these historic buildings, there's always going to be something that you don't expect. So what was kind of your how dangerous were you with construction knowledge before starting this project? I'm just curious.
Mark, I'm grinning from ear to ear here because, to some extent, I've grown up building things my whole life. But my professional career, my academic background is in chemistry. I have a couple degrees from Illinois in chemistry, and I've worked most of my life in neighborhood development work through not-for-profits. And so that has always engaged me in some form or other in construction, mostly renovation, but sometimes new construction. But my very first job was painting a fence with my carpenter friend. And so I've always been involved. My wife and I have done woodworking for many, many years. Sue calls it sawdust therapy. And so in some ways, Mark, we kind of knew enough to know that we could handle almost anything that came up. But then some things came up that we'd never seen before. But in the end, it's just stuff. And there are ways. And if you talk with Aaron or Ashley or Gary Anderson or somebody in the architect's office, they walked us through some of the things that we didn't immediately know. So I guess the short answer is we knew enough to get started, and where we got stuck, we asked the architects, and we also just muscled through some of it and figured stuff out. The contractors, the subcontractors that we used, I'm a registered electrician and have been for, 40 years or something like that. And so I've been around buildings and done stuff for all that time. But we had contractors for the HVAC, for the steel or iron work, rather, for the masonry work. We had the building tuck pointed and so on. and for the windows and the plumbing. And those folks worked beautifully with us and were super helpful whenever we ever got stuck. So that's kind of the long answer. And the interior finishing work we had significant experience with. And my only advice on that is if you want really great drywall finishing work, you want to hire my wife because she's just terrific at that.
Great. Well, appreciate the insight there, Brad.
All right, if there are no other questions, we'll go ahead and wrap it up today. In the chat is the link for our next webinar. We touched on historic tax credits a little bit today, but next time we're going to go more in depth with navigating the hoops of historical tax credits and other incentives. That will be on October 8th, and we hope to see you there. Thank you guys so much. Thank you, John and Brad, for joining us.
My pleasure.
Thank you all.
Thank you.
Thanks, everyone.